I spoke with John Flintham, Vice Chairman and Global CEO of Amtek Auto, about the earnings, and I began by asking him what happened in the year. They posted a loss of 987 crore rupees versus a profit of 848 crore rupees. Top line also declined. What led to this? What happened that hit the bottom line so significantly?
Yeah, there's two or three things. First of all, the PAT loss was pretty much anticipated. I think I talked about that at the last quarter. But within there, you've got a number of exceptionals, one-offs, which will not be repeated. We've got some significant cost-saving charges in there, restructuring charges in there, and also a one-off charge for the share sales of subsidiaries. So that's around about 360, 400 of one-off costs going through the PAT line. But fundamentally, the interest charges have gone up as the projects have been completed. Cost for those projects, interest for those projects until they were into production was obviously capitalised. Now that's now fully in the interest cost, which is why you're seeing an interest cost increase. And obviously, as a company, we took a decision with the company's law changing the depreciation arrangements. We decided to take that immediately rather than wait until next year. So you're seeing that in there as well. All of that is part of the PAT loss. Clearly, the reduction in the EBITDA, which is driven by an extremely sluggish and challenging Indian market, is one of the prime movers for this.
Now, last quarter, when he posted a loss of about 157 crore rupees, this was the first loss in about 20 years. You said that you had a bad quarter and it seemed it wouldn't be a recurrent theme. But again, on a standalone basis, you've got a loss of 158 crore rupees. On a sequential basis, your interest costs are the same, tax rate is lower, but you've not been able to materialize on the lower, capitalized on the lower material costs. Can you tell us what led to this pressure on the bottom line?
Now, material costs are not affected and don't affect the profit. The material costs are primarily a pass-through to all customers, so whether material goes up or down makes no difference to the added value. Lower material costs will reduce the top line, but not affect the margins. As we've said, fundamentally, what we've got is significantly undercapitalized assets, with running at sort of 50% capacity utilizations. We've got markets that are extremely challenging and depressed. We do have some price pressure in our Indian facilities, which is fairly normal in a time when volumes are down, people are chasing business. But primarily all the markets are down, and that's the prime reason in India for the EBITDA reduction. If you look at our business overall, and you've got to be careful about the mix, because some time ago, a year ago, we were talking less than 50% of our revenues coming from our overseas businesses. Now this is run rate of around 70 to 73% of our revenues coming from overseas businesses. And the overseas EBITDA multiples are lesser to India. So you've got to also tailor that reduction overall in the EBITDA to partly due to the mix issue as well.
What has led to the degrowth in top line? What was the growth in the auto and the non-auto segments?
As I said before, the main degrowth in the top line is in India. Our non-auto segment within India, which is the railways, oil and gas, agricultural tractors, construction equipment, are all extremely low in terms of volumes and demand in India. I think we all understand that. That's been well publicised. If you add that on top of commercial vehicles, which has gone up slightly in the last quarter, but it's coming from an extremely low base. We're seeing no recovery in the two-wheeler market, and the four-wheeler market, passenger cars, is slightly up, driven by good Maruti performance. But primarily overall, the domestic market is the main reason for the fall off in revenues. Our overseas businesses are performing very well. As you said, quite rightly, the American market is performing at the top end of its history. European markets, again, Germany and UK still continue to perform very well. Our Japanese business that we acquired in the previous quarter, that's performing very much in line with expectations. So overall, we're very satisfied with our overseas business, and we're ready and waiting for the Indian business to rematerialize.
But then can you put some figures on this? What was the growth in your international business?
Yeah, the growth has been around. It's very difficult to give you an actual figure because during the year we made substantial acquisitions. So I would have said if you looked on a base business and without acquisitions, I would have said we've seen something like, maybe 5 to 7% growth in our base business overseas, and then you add all the acquisitions on, and of course some of those you've not seen as full volumes during the year. So I would have said that come next year, actually 2016, which is our current new year, you will see further growth in our overseas business, and then obviously the recovery of the Indian market.
You said your utilization was around 50%. Is this the average utilization or just in India?
That's basically an average for our Indian businesses. We've added a lot of capacity in the recent past. If we go back to when we took the decision to make the capacity installation, there was some significant information in the marketplace and from talking to customers and various places for significant growth in the market. That's not really happened. If you look at the individual markets over the last 3 years, between forecast and actual, quite a few of them are down on a 3-year basis. So that is a very difficult market to be involved in. And I think if we look forward, 50% utilization across the board, more or less in India, and something in the region of, I would say, 70 to 75% is our utilizations overseas.
You've already announced a plan to sell some of your assets to cut down the debt. When will the interest costs start coming down?
In the last quarter, I think on this program, I declared that we were looking for a monetization program of around about $1 billion, which is 7,000 crores. Since that time, we've done a lot of moves forward in terms of particularly our overseas business. We said that the majority of that monetization would come from either the equity sale of a minority stake of our overseas business, which I think is worth an equity value of around about $2 billion. And we're looking to sell either between 25 and 40% of that. Or since we made the announcement, there's been significant interest into 1 or 2 individual companies of our overseas businesses. So I think as a management team, we've got to decide which is the best strategy for the company going forward. But the only thing I'm encouraged about is that I believe that we will beat the timing we set. We said we would achieve this within 12 to 18 months. I would be disappointed if we don't achieve the 12 months figure for the realization. So if you look at our consolidated debt, we're running at around about 14,000 crores, Amtek Auto consolidated, and if we look to raise 7,000 crores, then that would reduce the interest burden on the company significantly.
So what is the target for the next financial year? Will profitability remain under pressure for 4 quarters? Because you said that asset sales will take 12 to 18 months or so. Do you see improvement in the India business at all?
There's a number of questions there. Let me just try and dissect that and give you the answers one by one. Do I see India picking up? To be factual, no, I don't. I don't see any evidence of a recovery in the near future in India. I think it's going to be halfway through 2016 before we start seeing a recovery in some of the non-auto sectors, which is a big market for us. In terms of where we see our figures, you are aware that we are talking to our domestic banks about realignment of the debt and bring that realignment and debt maturities in line with our current cash flow forecasts. We anticipate that to be completed in the next 1 to 2 months. When we have that finished, then our business overseas will continue. So I would expect for certainly the next 2 quarters pretty similar EBITDA levels of what we're seeing today, and then we get the monetization program kicking in. So I think 2016 will be better than 2015, but until we get the debt reduction program fully in line, that's when you'll start seeing the real advantage.
So can you tell us what's your unexecuted order book as of date?
Yeah, we have secured new business in the region of over 13,000 crores, which is a significant new business. Now, that all does not come in at day one, obviously, because this is an engineering business. This takes time for the samples to be done, the engineering approvals to be made, and for those new orders to be, if you like, realised in terms of revenues. But this is encouraging for the upcoming quarters.
So that was the management of Amtek Auto talking about the earnings. They expect the stress to continue. Performance will be unchanged over the next 2 quarters, but they're hopeful of pick up in the Indian business sometime middle of next year.